Hi, I'm Stacey Parker, a research analyst with TeleGeography. I transitioned into this industry after a 15-year career as a full-time concert violinist. I think a colleague said it best. I simply transitioned from acoustic over to optical. I'm excited to be with you here today to present all sorts of great data and analysis across our work at TeleGeography. We're going to cover a lot, so I'll get right to it. We'll start with a global network update, then a wholesale pricing review, and I'll finish off covering emerging connectivity hubs. In general, I'll start from a global perspective and then dial into a European focus, and there will be a QR code at the end if you'd like to reference any of the slides. Global bandwidth demand continues to increase while the pace of growth has been slowing. Here we see used international bandwidth by year in the dark blue columns and the annual growth rate in the light blue line. Between 2020 and 2024, the demand growth rate decreased from 45% down to 29%. Some factors for this slowing include cable delays and the localization of content and applications keeping more traffic local. But it's worth noting the law of large numbers. A large entity which is growing rapidly cannot maintain that growth pace forever. Plus, slower growth can still lead to a tremendous amount of new capacity. With a steady CAGR of 32% over these years, we saw a tripling of demand, reaching over 6.4 petabits per second. So, who is using all this bandwidth? As recently as 2016, internet backbone providers accounted for the majority of bandwidth demand. But now, content and cloud providers, specifically Meta, Google, Microsoft, and Amazon, account for almost 3/4 of all bandwidth demand. Let's take a look at this 100% bar chart. While the content provider's dark blue share of total demand varies by route, it's becoming dominant just about everywhere. On the transatlantic, transpacific, and intra-Asian routes, content provider networks make up at least 80% of bandwidth demand. A few routes are still driven by internet backbone demand, but that is rapidly changing. For example, on the Europe to Middle East route, the light blue share of internet backbone capacity is strong at 59%, but content provider networks in the Middle East are growing, and this dynamic is shifting. Here's another perspective on content providers' share of used interregional bandwidth. The thickness of these dark blue lines represent the capacity of used bandwidth between regions. For example, the thickest segment here connects the US and Canada with Europe at a whopping 884 terabits per second of used bandwidth. But when I overlay content providers' share of used bandwidth in light blue, the content providers use 93% of that 884 terabits per second across the Atlantic. This map also displays Europe's critical and growing connection to other parts of the world. In fact, Europe serves as the major interconnection point for Africa and the Middle East. Growth on the Europe to Africa route has been driven by aggressive bandwidth deployments to sub-Saharan Africa by content providers. With the launch of Equiano, capacity jumped by 45% in the last year. Skyrocketing bandwidth growth across the Atlantic Ocean has been due to new cables like Maria, Havfru, Dunant, and Grace Hopper, as well as upgrades on older systems. The activation of Anhana will continue the surge in new transatlantic capacity. Now, let's zoom in on the bandwidth connected to Europe, but let's take the content providers out of the equation. We'll only cover the bandwidth deployed by internet backbone providers. Here you can see how different regions rely heavily on access to Europe. The height of each line demonstrates how much of each region's bandwidth has been connected to Europe over the past 10 years. At the top of the graph in dark blue, Northern Africa has essentially been bolted to Europe for connectivity, and a while ago the same was true for sub-Saharan Africa in light blue. But links within sub-Saharan Africa have grown substantially due to data centers and internet exchanges building out, content providers moving in, and CDN caches all keeping more content local. As a result, we've seen a decline in sub-Saharan Africa's share of bandwidth connected to Europe. But make no mistake, even though this percentage is decreasing, the absolute volume of capacity is growing. And of course, keeping all this international bandwidth connected would not be possible without submarine cables. New cables are necessary to keep pace with rising global demand, especially as we're hitting the limits of how much data can go through existing fibers. Commercial strategies are focusing on building extensive networks as hyperscalers require multiple paths for diversity. As a result, we've seen substantial investment in submarine cable infrastructure globally, with an expected surge in investment across all routes in the coming 3 years. The largest surge is expected in the Trans-Pacific region, with an aggregate $3 billion forecasted spend. In total, the value of new cables entering service is forecasted to reach $13 billion. Cables across the transatlantic ocean have become quite diversified in recent history. 10 years ago, on the European side, cable landings were focused in the UK and the northwest of France. But today, they span from Scandinavia down to Portugal. Bilbao has become a new cable landing destination for transatlantic cables, hosting Grace Hopper and Maria. And it's no coincidence there are hyperscaler data centers nearby. From Bilbao, if we follow the Iberian Peninsula around into the Mediterranean Sea, Europe is becoming less reliant on Marseille as the major cable landing hub. Cables such as To Africa and Medloop land in Barcelona, with Medusa due there soon. And Genoa serves To Africa, Blue, and Medloop. Plus, it just launched Unitirreno last week, with EMC West 1 and 2 on the way. Marseille has been a traditional and stalwart hub for Europe, with many cables traveling east out of Marseille, while cables in Lisbon often travel south down to Africa. Looking north, you can see Ireland and the Nordic countries host several cable landings, serving many cables designed to connect data centers. And if you listen to the news, more and more we're hearing of cable breaks requiring immediate repair, especially as geopolitical tensions rise. But just because we might hear more reports on cable faults today, that does not mean more cables are breaking. In fact, cable faults are incredibly common and have occurred very regularly over the years, averaging 199 faults per year. They're almost always accidental from natural causes or unintended anchor damage. And even as the number of submarine cable kilometers has increased, the number of faults has remained steady. In general, it's a good thing we're examining cable faults and boosting cable awareness. This scrutiny should make sailors think twice about where and for how long they drop anchor. And this is something the industry has pushed for a long time. Continuing eastward, 4 cables suffered faults in the Red Sea last month, majorly disrupting connectivity between Europe and Asia, India, and East Africa. They're still down. Unfortunately, this is not a new problem. In February 2024, 3 Red Sea cables were clipped, which took months to repair. These cables are essentially on top of each other in a choke point riddled with geopolitics and permitting nightmares. Complex repairs continue to place great strain on this route. To make matters worse, there are indefinite delays on desperately needed new high-capacity cables due to the same difficulties. As a result, we've seen incredible investments bypassing the Red Sea terrestrially, whether through Saudi Arabia, avoiding the choke point in the Red Sea, or north through Iraq and Turkey, avoiding the Red Sea altogether. These routes are especially crucial as hyperscalers are insistent on requiring multiple paths for resilience. Okay, so we've gone pretty deep into global infrastructure, bandwidth, and even geopolitical factors. Now, when we put all these variables together, what's the impact on pricing? Generally speaking, more high-capacity cables lead to lower unit costs, which leads to lower prices. And if there are any 2 predictable trends in the wholesale market, they are persistent demand growth and persistent price erosion. But market competition matters as each global route has different dynamics. Diving back into the Red Sea, the 3-year CAGR decline for 100 gig on the Marseille-Singapore route was very slow at 1%, a direct reflection of the recurring supply constraint we just discussed. While routes to Africa are relatively expensive, between $30,000 and $40,000, the price decline has been significant at 14% and 18% due to the influx of new African subsea capacity. But underlying costs matter, and there is a floor. The 100 gig price on London to New York has been so low, it's been hard to imagine it can go much lower, yet we still saw a 6% decline. And though we discussed skyrocketing bandwidth on this route, keep in mind that 93% of that was content provider capacity, not internet backbone capacity in the wholesale market. Now, when we look at the same type of data on terrestrial routes across Europe, you can see there is less variation in price and decline due to the extreme interconnectedness of the region. These 100 gig prices have seen 3-year CAGR declines range from 10 to 20%. We typically see the lowest prices on the ultra-connected flap routes, Frankfurt, London, Amsterdam, Paris. In Q2 2024, the weighted median on Frankfurt to London was about $1,100, with a strong decline of 18%. This is a reflection of investment and new technologies emerging within Europe's hubs. Frankfurt to Sofia had the highest weighted median on this chart at 1850, with a 15% decline. More carriers are expanding outward to Sofia as it's proving to be a pivotal interconnection point between Central Europe and the Middle East. We expect long-term price erosion will remain the norm globally. The pipeline for new cables is strong. We anticipate the obstacles to complete new cables in the Red Sea will be overcome, and price erosion will return to normal levels. But to be fair, we're not seeing 25 or 30% erosion commonly anymore. We're seeing more like 10 to 15%. Recall the very first slide on bandwidth growth slowing. This in itself leads to slower price erosion. Here we forecast 100 gig price erosion through 2031, ranging from 11% on Frankfurt to London and London to New York to 18% on Marseille, Mombasa. We often focus on 100 gig waves as they tend to make up the bulk of sales in developed countries. There is still a market for 10 gig waves, but shifts to higher capacities like 400 gig put pressure on 100 gig prices. And we are definitely seeing sales mixes shift towards those higher capacities. 400 gig adoption has been primarily led by the hyperscalers, but it's also embraced by cloud providers, AI builders, CDNs, carriers, and large enterprises. Use cases include cloud computing, data center interconnectivity, upgrading core and backbone networks, and enterprise connectivity. Beyond 400 gig, we expect the next increment in the wholesale market will be 800 gig. And beyond lit wavelength, some customers are shifting to long-haul dark fiber. More and more, though, we're seeing the role of network operators evolving. They're becoming integral partners to the major technology companies, often managing entire fiber optical networks, leveraging their extensive infrastructure and specialized teams. The rollout of 400 gig is still in the early phases around the world, but there is one regional exception. As investment in AI has soared, the United States has shown broad adoption of 400 gig waves to interconnect data centers in anticipation of what's to come. But the true impact of AI on long-haul bandwidth and data center requirements remains a puzzle. No one really knows how it's going to play out. Requirements for training versus inference vary greatly. Much of AI training is currently centralized in North America, while in Europe there's less training due to cross-border regulations around data sovereignty and AI. As for inference, it may likely happen in a combination of locations, on devices, in data centers, and places in between. As workload balance shifts from training towards inference, expect to see the distribution of AI workloads spread globally. And while the craze for 400 gig waves to interconnect data centers has been largely contained within the US, 400 gig is poised to eventually become the new global standard. Price compression of 400 gig can incentivize customers to upgrade from 100 gig. On Frankfurt to London, the weighted median 400 gig price was just 2.7 times more than the 100 gig price for 4 times the capacity. The same price multiple was higher on the London to New York subsea route at 3.9, though individual carrier multiples extended down to 3. There are additional infrastructure and equipment upgrade costs when transitioning to 400 gig, but the savings on install, cross-connect charges, and power consumption can make up for that over time. Across these terrestrial routes, price multiples between 100 and 400 gig prices ranged from 2.6 to 3.4, with individual carrier multiples extending down to 2.5. The flap routes have immense capacity requirements as they connect the largest business hubs in Europe. So it's no surprise we see the most competitive 400 gig prices between the flap cities, with weighted median prices around $3,000 for 400 gig. Reported lows extended down to $2,500. Though some carriers demonstrated flat or tiered pricing across routes, Frankfurt to Milan and London to Madrid often had higher pricing. 400 gig weighted median prices on those routes were 3 and 3.4 times more than their respective 100 gig prices. In this forecast series chart, you can see our projected flattening of prices on Frankfurt to London approaching the year 2031. We expect the prices across capacities will compress as unit costs decrease with increasing supply. Lower capacity connectivity becomes less relevant as market demands shift higher. And also keep in mind that as this curve flattens, even higher capacities like 800 gig will begin descending into this graph. Globally, trends in the IP transit market usually mirror regional trends of the transport market, as IP transit relies on these high capacity links. So when transport prices go down, IP transit prices usually follow suit. Just like the significant 100 gig wavelength declines on African routes, we can see how the effect of new subsea systems to Africa triggered a striking 22% IP transit price decline in Johannesburg. And again, like the previous flap wavelength routes, established network hubs like London and New York report the lowest prices and often more modest decline. Across large European cities, 100 gigi weighted median full port prices range from 9 to 11 cents per meg. The bigger story here is the bottoming out of reported prices. At the end of Q2 2025, 100 gigi low prices in Europe and the US remain steady at 5 cents per meg. Finally, to further explore how price differences have evolved over time, we'll compare IP transit prices in global cities compared to London. We'll switch to 10 gig E as 100 gig E services only really took hold in some of these markets more recently. New infrastructure and declining transport prices create opportunities to sell IP transit in developing markets locally. And recent price reductions have driven some convergence in the market. If you look at the red line in 2020, the price in Johannesburg was 10 times more than the price in London at the bottom. But in 2025, it was just 3 times the price in London, which brings it more in line with the other internet hubs. Slow erosion in developed markets have resulted in pretty flat lines for New York and Singapore. While Singapore, the yellow line, is a regional hub, differences in underlying costs and service providers have maintained this gap. Okay, so outside of pricing trends, one thing we're often asked at TeleGeography is, where's the next big hub going to be? And with news stories every day about tech investments, planned data centers, strategies for clean power, and the digital gold rush, it can really be a daunting question to tackle. A simple place to start is by examining where cloud regions are growing. We've seen increased efforts to move cloud services closer to the end users as latency is crucial for edge computing and high performance real time applications. This map shows cloud data center and on-ramp locations in the blue circles, with the red circles representing planned cloud regions. Cloud providers are planning to launch at least 34 new cloud regions over the next couple years, with 9 regions expected in Asia and 4 in the Middle East. You can see Africa is planning new cloud regions outside of South Africa, in Morocco, and Kenya. In Europe, the demand is soaring. Operators are planning to launch 12 new cloud regions starting in 2026, in addition to the 57 live cloud regions. Germany has the most, with the UK a close runner-up. Microsoft in light blue has aggressive plans with new facilities on the horizon in Greece, Belgium, Denmark, Finland, and Austria. Google in dark blue is planning new facilities in Greece, Norway, Sweden, and Austria. But deployment of cloud services is just one piece of the puzzle when thinking about interconnection markets. Other important factors for rising hubs include a city's network connectedness, pricing, internet exchanges, data centers, power supply, the economy, governance, and regulations. About a year ago, we launched the Market Connectivity Score, offering a new way to assess global connectivity. And since we love data at TeleGeography, we merged data sets from across our products with third-party sources on power, governance, and more to evaluate market health. The Market Connectivity Score captures 45 distinct market health metrics to help users diagnose the competitiveness of 3,000 global networks and data center markets. These results can be sorted, filtered, and ranked by current score or fastest growing city score. And the user can adjust how heavily each metric is weighted, putting the evaluations in the user's hands. Inside the MCS, you can compare individual cities. Here you can see polar charts overlaid comparing Madrid and Vienna. The fuller the color in the circular chart, the higher the score. While both of these cities have similar shapes and similar scores for pricing and local access, there are some distinct differences. Madrid in dark blue has higher scores in cloud infrastructure, data centers, and power. But Vienna in light blue leads in internet exchanges, long distance transport, and regulations and governance. Moving east, let's compare Istanbul with Sofia. Both of these cities have become vital gateways for traffic flowing from the Middle East, especially traffic being diverted around the Red Sea. Both cities show similar rankings for pricing and cloud infrastructure, but Istanbul has more data centers in service, stronger demographics, and a higher local access score. Sofia has more internet exchanges, stronger peering, and higher governance scores. Also crucial is the fact that Sofia has a higher power score. Of course, for any data center to thrive, it needs gobs of power. And you maybe have even heard quotes and catchphrases like, you need to produce your own power to control your own revenue. Or in the US, an environmental group has coined the acronym Beyonce after the pop singer. It's a strategy for data center businesses that stands for Bring Your Own Clean Energy. So, of course, power is a huge metric in our tool. The MCS evaluates cities based on existing and planned clean power, existing and planned total power capacity, and it also measures the clean power share of overall capacity. Here, we've ranked just the planned power capacity across Europe. With the highest score, Dublin has two Bord Gáis gas-fired plants coming online later this year, and the Poolbeg open-cycle gas turbine plant coming in 2027. And here are our top 5 fastest growing metros in Europe, based on the metrics for planned cloud regions, data centers, submarine cables, clean power, and total power capacity. Again, all planned and not current metrics. Looking at our top fast growth list overall, it may be surprising to see Dublin and the German cities on the list. These data center markets have faced major obstacles due to concerns about power usage. But operators are persisting in planning new data centers in these places despite their challenges. And in the case of Dublin, the push for clean power development further propels it high on our fast growth list. Copenhagen also has strong scores for both power and cloud infrastructure. Here's a chart of our current top 10 European cities. The columns show you each city's rank by individual category, with stars denoting the top 5 in each group. 2 cities dominate multiple categories, London and Frankfurt. London's number 1 for commercial data centers, cloud on-ramps, international cities directly connected, WAN service providers, and local access. Frankfurt is number 1 for internet exchanges, peering, CDNs, cloud regions, and international internet capacity. And while this chart may appear that Frankfurt should be first, we need to consider the other categories not listed in the columns. For example, London scores better than Frankfurt for power, geography, and demographics. And finally, if you'd like to stay up to date with our rankings, you can scan this QR code to see our public top 10 lists of the most connected and fastest growing cities globally. We just updated it earlier this month, and we refresh the data and rankings quarterly. Thanks so much for listening. like a great piece of classical music that makes you see life a little differently once it's over. I hope telegeography's data was able to give you a new appreciation and perspective on our industry today.